Welcome back to the Legacy Radio Network. This is Everything Financial Radio. We have the pleasure today of chatting with Professor Laurence Kotlikoff. And, Professor, I want to jump right in where we left off because you were talking about the Social Security program and the Medicare program. Certainly those are big parts of the debate now as the so-called fiscal cliff is looming. When you look at Social Security and Medicare, just how big is the problem? I guess you alluded to that in the last segment, but more importantly, can this fiscal gap problem relating to these two programs be solved?
Yes, absolutely. If you go to the thepurpleplans.org, you'll see proposals I have to fix health care, the Social Security system, taxes, the banking system, energy. And these are very simple proposals that a number of very prominent economists, including Nobel laureates, have endorsed. They're really what economists think is appropriate, not what political economists like Paul Krugman or Glenn Hubbard would think is appropriate, because they're really focused on politics, not economics. The way we need to address healthcare is we have to give everybody the same a basic plan, financed by the government, and we have to keep this expenditure at 10% of GDP. So everybody should get a voucher that's predicated on their pre-existing conditions. So the vouchers would be bigger if you're diabetic, for example, than if you're perfectly healthy. And a panel of doctors would say what's covered by the basic plan. And so the cost of all the vouchers, if you add them up, would never exceed 10% of GDP. In other words, what's covered would never be expanded beyond what could be covered by 10% of GDP. Now, that gives everybody a basic plan. We still have private provision of the basic insurance plan, so the insurance companies have to take your voucher and they have to provide you the basic plan. And old people, young people, middle-aged people, they all get the same basic plan. We shouldn't be giving basic health insurance that's much better for 90-year-olds than for 5-year-olds. That's just not ethical. It's not generationally ethical. It's immoral to say somebody who's 90 who's got a heart problem is more deserving than somebody who's 5 years old with a heart problem. So the CBO is projecting, the Congressional Budget Office is projecting that 10% of GDP under the current structure of Medicare, Medicaid, and the new Obamacare is going to go up to 30% of GDP. That's going to completely bankrupt the country. We need to keep it at 10% of GDP. The Purple Health Plan does that. The Social Security Plan is also straightforward. I could go through it, but I don't want to take all your time on it. But there are solutions that economists like myself can come up with. We have 535 members of Congress. Not a single one of them has an economics degree in terms of an advanced degree, as far as I understand. So, you know, you've got people that have no idea what they're doing making economic policy, and it's a mess. And it's going to destroy the country and our children.
Professor, you have stated in past appearances on the program and in some of the articles that you've written, and I think we've discussed that and established that in the first segment today, that the United States is bankrupt, a fiscal basket case, and in worse shape than the bailed-out countries of Greece, Ireland, and others. And that may come to a shock to some listeners because Greece is, in my view anyway, in a deflationary depression currently. Explain, if you will, what will be the ultimate consequences of these fiscal issues unless the politicians pursue a different course of action? When does this rooster come home to roost, and what will the consequences look like for an average American?
Well, the government is printing a lot of money to pay for its bills, and the prospect of it continuing to do so are very high. So we're going to end up with a lot of inflation, and anybody buying long-term Treasury bonds and other securities that are not inflation adjusted, that are denominated in dollars, is going to get burnt. At some point, interest rates are going to spike up. People are going to realize that the U.S. can't afford what it's going to be the same situation as in Greece or Argentina today. When countries spend more than they can afford, things blow up. It may take a while longer for the U.S. for this to happen, but it's inevitable. The reason we're in worse shape than Greece is we've got an exploding healthcare expenditure problem interacting with the demographics. They have complete control of their healthcare spending, so they have a lid on it, and they're in very bad, terrible shape don't get me wrong, but they're not quite as bad a shape as we are when you look at everything comprehensively. They've got a pension system that they've actually reformed. We haven't reformed ours. Our Social Security system is, as I said, 31% underfinanced. Our taxes are historically low as a share of GDP, and everybody's screaming about raising them. The president is the biggest screamer here. In terms of not wanting to raise them on the middle class, well, I'm not saying we shouldn't raise them on the rich. I think we should, but we should raise taxes on everybody because it's essential for our children. So we're not going to get enough resources out of the rich alone. And by the way, I don't favor keeping the existing tax system. I would junk it and go to the purple tax plan, which is a broader base. It's got it's a tax reform with much lower rates, a broader base. It's much more progressive than the current system. It's really a very simple solution for our country. So there are ways ahead, but we're not taking them.
Professor, you mentioned that the Federal Reserve is printing money, and I want to go back and get your take on the inflation issue if we have time. But I noted that in the prologue to your book, The Clash of Generations, you describe a day in the future when the U.S. dollar may no longer be taken by the rest of the world due to this excessive money printing. Can you give our listeners an idea as to when you think that day may come and what the consequences will be for those trying to accumulate or protect a nest egg should the U.S. dollar no longer be the world reserve currency?
Well, when exactly the bond traders are going to wake up to understand the fiscal realities is anybody's guess. You see, everybody thinks that, well, you can just fix Social Security and everything will be fine. You can tweak it, or you can tweak Medicare, Medicaid. But the problem is that you've got 33 million people over 65 today, and what the politicians are saying is that we can't touch a single dollar of benefits that they've been promised. Now, that's just a non-starter. So the bond traders on Wall Street, who are continually, and the Wall Street guys in general, are getting things wrong. Every time there's a crash, it's evidence that the entire industry has missed some part of reality. So they're getting this wrong too. And at some point they're going to wake up. Now, whether that's going to be this year, next year, or 5 years, I just can't say. But I would not touch a long-term U.S. Treasury that's yielding such a low return with a 10-foot pole, even though I love our country and want to get it fixed. I wouldn't advise anybody to buy Uncle Sam's paper because Uncle Sam's going to default on it. And he's not going to do it by the way the Greeks did, which is basically saying we're not going to pay back principal plus interest. He's just going to print money and pay back in watered-down dollars.
Now, Professor, I'm sorry, just to jump in there because inflation, by definition, is an expansion of the money supply. Deflation, by definition, would then be the polar opposite, a contraction of the money supply. And given the massive debt levels that exist today, and given that we're seeing foreclosures and we're seeing money being pulled from the system through defaults, is it your view then, am I reading this correctly, that the Fed will actually be able to print more money and expand the money supply faster than money leaves the system through defaults due to massive debt levels?
Well, because we have a rather depressed or anxious economy, and where people are very concerned about Europe and somewhat concerned about, not enough concerned about the U.S. fiscal situation, and also concerned about China, there's a big demand for cash and for these Treasury bills and bonds. But the Fed is printing money like out the wazoo, and eventually people will see that this is going to culminate in inflation. You just can't print. You just can't pay for your bills by printing money endlessly. At some point, it's going to blow up in your face, and it's happened. And we had something like 20 hyperinflations in the last century. No country's been able to get away with this kind of finance for over the long term. So I think the Fed's actions have, we might actually be seeing prices decline. We might even be seeing a deflation right now had it not been for the Fed printing so much money. But at some point we can flip from basically no or very modest inflation to very significant inflation. That's the kind of thing you can see economies do when policy is really off track. You can see them react very quickly in a bad way. Just like we saw in 2008, everybody got terribly nervous about Lehman Brothers failing. The politicians scared the hell out of everybody. President Bush said the sucker's going to blow, was his way of putting it. That was a brilliant statement by the President of the United States. He panicked the entire, millions of employers who immediately started laying off hundreds of thousands of people per month. And in 19 months, we had 8.5 million people laid off because everybody thought everybody else was going to lay off, thanks to President Bush leading the charge. And Hank Paulson, think about it. Lehman Brothers failed, but the bank building itself didn't disappear. The people inside the building didn't die. So the physical productive capacity of the country wasn't changed at all. And so people bought up the building, and other people hired these guys who were laid off by Lehman, and that part did not kill the economy. What killed the economy was collective panic. And somebody who is an adult leader should have gotten on the stage there and said, look, you guys are all panicking. You're in the process of firing 8.5 million people. Stop it. Go back and rehire these people. And guess what? All the customers you fear you won't have, you're going to have them because you're all going to hire collectively, and you're going to see that you all now will have customers. So President Roosevelt had this right when he said, the only fear to fear is fear itself. And what we're doing here, and that's a real fear. Fear is a very real fear when it comes to economics, and what we're doing here is manufacturing fear.
Professor, we have time, about a minute left. Given the current economic situation and political situation, what advice would you give to listeners in managing their nest egg? And I guess what I'm getting at is, if you're looking for maybe inflation or hyperinflation, does that make you bullish on equities?
I think equities are probably a relatively good investment at this point. Gold I'm a little bit nervous about because gold's priced so high. I think foreign securities, I think real estate is really something that people should be looking at carefully. Interest rates are very, very low for more borrowing, and the real estate prices are relatively low at this point. Certainly in some places of the country they're very low. So this is the time, particularly for younger people, to get into real estate. It's a very secure asset. If you can live in your house, you've got a stream of housing services that continue till you die. It's really like getting into an annuity. So real estate, think about countries where, if you want to get into bonds, think about Canada's got a fiscal policy that's quite solvent, New Zealand, Australia, Chile. There are a few countries around the world that are actually run by adults, and they're safe places to invest in terms of bonds. And then just diversifying your stock holdings around the globe is a good thing to do. But unfortunately, I don't have, if the U.S. implodes, it's going to bring down the entire world economy, and everything could fail. I mean, in terms of all securities could be hurt. So there's nothing perfectly safe in a very correlated world economy.
Professor Laurence Kotlikoff, we're going to have to leave it there. We thank you for joining us today and hope you'll come back.
I'd be happy to come back. Thanks so much, Dennis.
Everything Financial Radio will return after these words. Stay with us.